The American economy is currently bleeding an additional $500 million every single day as oil surges over 50% following the February 28 strikes on Iran. With Brent crude shattering $110 a barrel and the Strait of Hormuz effectively shuttered, the $3.70 national gas average is merely the first of 5 compounding waves designed to bypass your financial defenses. Most investors will mistake this for a manageable spike, but a cold analytical look at the data reveals a rolling series of shocks that will paralyze household budgets long before the final wave hits. The staggering drain of $500 million every single day is not a temporary glitch or a quarterly adjustment. It is a relentless, compounding hemorrhage that is accelerating as you read this. To understand the gravity, look back to February 28. That date marked a permanent shift in the global landscape as the joint United States and Israeli strikes on Iran detonated a geopolitical powder keg. Since that moment, the cost of oil has rocketed over 50%. This volatility centers on the Strait of Hormuz, a narrow 21-mile gateway that serves as the jugular vein for the global energy market. For the first time in recorded history, this channel, which handles 20% of the entire world's supply of crude oil and natural gas, has been choked off. The result is a pricing environment where Brent crude, which hovered at a stable $70 per barrel only 3 weeks ago, has now breached the $110 mark. While these macro figures feel distant, the direct hit to your pocketbook is undeniable. The national average for gasoline has abandoned its sub-$3.00 baseline, climbing rapidly to $3.70 per gallon. In California, the situation is even more dire, with residents facing prices exceeding $5.30. However, the true silent killer of the American economy is diesel. This is the industrial lifeblood that keeps the 18-wheelers moving, ensuring that every product you consume actually reaches the shelf. Diesel prices have exploded by 36%, now sitting at nearly $5.10 per gallon. When the circulatory system of commerce becomes this expensive to maintain, the entire body of the economy begins to fail. The average American household typically allocates $2,500 annually for fuel, which breaks down to a predictable $50 each week. When that weekly bill suddenly creeps up by an extra $10 or $15, most people fail to trigger a red alert. Your internal radar mislabels this as a minor nuisance rather than a systemic threat. This is a dangerous cognitive error. Psychologists describe a phenomenon where we sort our finances into mental silos, like separate drawers in a desk for groceries, leisure, and utilities. When the fuel drawer catches fire, we don't calmly reallocate our resources. Instead, we panic shred the other files. According to the chief economist at the National Retail Federation, this leads to an immediate abandonment of experiences. The moment a mandatory cost like gas spikes, your survival instinct rebrands joy as a luxury. Movie tickets, theme park visits, and restaurant reservations are the first to be sacrificed. You stop contributing to your investments and cancel the gym membership, not because the gym got more expensive, but because your brain is desperately trying to balance a sinking ship by throwing the cargo overboard. This psychological paralysis is exactly what makes the current crisis so lethal. Most observers are treating this as a singular event, but the reality is far more complex. We are witnessing a sequence of 5 distinct, overlapping shocks, each one hitting with more kinetic energy than the last. You are currently standing in the foam of the first wave, gasoline. It hit within days of the initial conflict and is the most visible sign of trouble. However, while you are busy staring at the numbers flipping on the gas pump, the second wave is already breaking over the horizon. By the time the general public realizes the full scope of this 5-part cascade, the majority of the damage will be irreversible. You must override your natural tendency to minimize this threat and recognize that the fuel spike is merely the opening act of a much larger economic transformation. Surged into a realm of unprecedented volatility, the logistics of your dinner table are facing a vertical climb in costs that most consumers have yet to fully register. While fuel pumps grab the headlines, the real danger lurks in the refrigerated aisles. Supply chain researchers have identified grocery stores as the front line for non-gasoline inflation, specifically targeting perishables like fresh produce, meat, and dairy. These items are the ticking clocks of the economy. They cannot be mothballed in a warehouse to wait for a market correction. Every gallon of diesel powers the cooling units and engines of the trucks keeping these goods fresh, and with diesel experiencing a 36% price spike, the cost of transit has effectively entered a new stratosphere. Most retailers are currently attempting to play the hero by absorbing these overheads, mirroring their response to the tariffs of the previous year. However, their financial buffers are exhausted. An economics professor at Boston College has warned that if oil remains at these levels, businesses will lose the ability to eat these expenses. Once the threshold is crossed, sticker prices will leap upward with startling speed to bridge the gap. Even more insidious is the third wave of this crisis, which is currently invisible because it is buried in the soil. You might not feel the impact of the fertilizer shock today, but the economic fuse was lit this March. Fossil fuels are the primary ingredient here, accounting for a massive 80% of fertilizer production costs. This creates a direct pipeline from the war zone to the farm, as major producers like Iran, Qatar, Saudi Arabia, Bahrain, and the UAE find their exports crippled. With the Strait of Hormuz currently obstructed, 1/3 of the entire global fertilizer supply is trapped behind a geopolitical wall. While you go about your day, farmers are already paying massive premiums for the inputs required for this year's harvest. This means the meals you plant for September and October are becoming more expensive right now, long before you ever see a receipt. It is a slow-motion car crash where the impact is scheduled for the fall, yet the brakes failed in the spring. As we look toward the horizon of the fourth wave, the sky itself is becoming more expensive. Jet fuel has skyrocketed by approximately 85% since the commencement of hostilities, forcing global aviation giants like Qantas, SAS, and the premier carriers of India to implement aggressive fare hikes. Unlike the daily fluctuations of a local gas station, airlines operate on rigid, long-term pricing models. They bake their fuel costs into tickets months in advance, which means even a sudden drop in oil prices tomorrow won't rescue your summer vacation budget. Those planning to fly this season will find that the financial turbulence has already been integrated into their boarding passes. Finally, the most profound shock arrives in the form of a total reversal of the interest rate landscape. The widespread hope that the Federal Reserve would slash rates this year to ease the burden on mortgages, credit cards, and auto loans has been completely extinguished. That optimistic projection is officially dead. Financial experts now suggest that a rate cut is impossible until the third quarter at the earliest, and should inflation continue to overheat, we may actually see rates climb further. For anyone standing on the verge of a home purchase or a refinance, the ground has shifted fundamentally. This collision of rising costs and geopolitical chaos is forcing a psychological freeze. People are not just spending less, they are paralyzing their long-term plans. The decision to delay a new home, a car, or a renovation often stems from a loss of faith in tomorrow's purchasing power rather than a lack of funds today. The sudden decision by millions of families to halt their spending simultaneously creates a gravitational pull that can drag the entire national economy into a dark descent. Consider the moment the news broke regarding the Iran conflict and the subsequent explosion in oil costs. Did your internal radar immediately detect the complex web of secondary failures, or did it only register the most obvious hit? Most people link one or perhaps two consequences, which is a perfectly natural human response. However, that very sense of normalcy is a trap. Behavioral scientists identify this as anchoring bias, a cognitive glitch where your brain fixates on a single, vivid lighthouse in a storm while ignoring the jagged rocks beneath the surface. For the average American today, the neon digits on the corner gas station sign, whether they read $3.70, $4.20, or $5.30, have become the sole metric for this crisis. This number acts as a deceptive placeholder for a much larger catastrophe, tricking your internal defense system into classifying a historic emergency as a mere nuisance to be endured. Analytical data suggests a far more aggressive reality than a simple trip to the pump. One prominent economist calculates that this surge in fuel costs alone is set to drive monthly inflation to 1% for March, marking a peak not seen in 4 years. This trajectory puts annual inflation on a path toward 3%, even before we account for the looming price surges in groceries, agricultural nutrients, and aviation. The International Energy Agency has discarded moderate language, officially labeling this period as the most significant threat to global energy security in human history. Yet, because of our mental fixation on the gas pump, we find ourselves whispering that we can manage, comparing today's prices to last month's instead of bracing for the tidal wave. This mirrors the 2022 aftermath of the Russian invasion of Ukraine. Back then, a spike in gas led to widespread grumbling, but while consumers were focused on their tanks, the poison bled into housing, food, and basic services until inflation shattered the 9% ceiling. By the time the public recognized the true scale, their wealth had already been eroded. You are not failing to see this out of irrationality, you are simply operating on the standard issue cognitive hardware shared by everyone else. Overriding these factory settings is the only way to protect your future. Nowhere is the need for this clarity more urgent than in the realm of your retirement and savings accounts. The S&P 500 has shed nearly 7% of its value since its peak in January, but the instability is far more widespread than a single percentage point suggests. The Dow Jones Industrial Average has just concluded its fourth straight week of losses, a downward trend the market has not witnessed in 3 years. If you are positioned in broad index funds or target date portfolios, you are already feeling the heat. Even the Nasdaq, powered by the tech giants meant to be the primary drivers of 2026 growth, slipped 10% from its summit into correction territory. Meanwhile, the Russell 2000, populated by smaller firms that are extremely vulnerable to shifting credit costs, officially plunged into a correction last Friday, marking a drop of more than 10% since the start of the year. The traditional shelters are also showing structural cracks. Gold, historically viewed as the ultimate financial bunker, briefly soared past $5,400 per ounce before suffering a brutal 10% collapse in just 7 days, representing its most disastrous weekly showing since 1983. The internal alarm system of the average investor is currently flashing a blinding red as the VIX, often called the fear gauge of Wall Street, has violently doubled from its mid-teen baseline to nearly 32. This surge reflects a breakdown in conventional wisdom, where even the most boring, safe havens are failing to provide their expected shelter. When your screen is a sea of crimson, your amygdala, the ancient biological radar for predators, overrides your rational mind with a single, deafening command to flee the market. This is the heavy hand of loss aversion at work. Research conducted at Princeton highlights that the psychological sting of a financial deficit is twice as sharp as the thrill of an equivalent gain. Consequently, a $5,000 dip in your retirement account does not register as a manageable setback, it feels like a $10,000 catastrophe. Our nervous systems are still running prehistoric code designed for physical survival in a world of immediate, fatal risks, a hardware configuration that is fundamentally incompatible with the long-term volatility of a modern 401k. Yet, what is the actual price of surrendering to these survival instincts during a global conflict? Historical data suggests that panic is a far greater threat than the bullets themselves. An analysis by RBC Wealth Management covering 20 significant military interventions since World War II found that the S&P 500 averaged a decline of only 6% during the active conflict. Another exhaustive 85-year study involving 40 distinct geopolitical shocks revealed that while the initial month might see a negligible loss of 0.9%, the subsequent 6 months typically deliver a recovery gain of 3.4%. Consider the chaotic onset of the pandemic in March 2020. The market managed to erase its entire deficit and return to its starting blocks in just 57 days before embarking on a massive rally. Those who abandoned their posts at the bottom essentially nailed their losses to the floor, while the patient observers reaped the rewards of the inevitable bounce. The most punishing aspect of this behavior gap, the chasm between market performance and what the average person actually earns, is the proximity of the best and worst trading days. They move in tight clusters, like a storm front where the brightest lightning follows the darkest clouds. If you attempted to time the market over the last 2 decades and missed just the 10 best days, your total returns would be slashed by approximately 50%. Missing the top 20 days would leave you with a portfolio that barely outpaces the cost of living. You simply cannot participate in the sunrises if you have evacuated the field during the nighttime. Most investors fail because they treat their portfolios like a mood ring, buying when they feel buoyant and selling when they feel terrified, which is the exact inverse of a successful wealth-building strategy. This psychological struggle is occurring against the backdrop of a genuine economic nightmare, stagflation. This is the toxic intersection of runaway inflation and stagnant growth, a scenario where the standard financial steering wheel locks up. If the Federal Reserve raises interest rates to throttle inflation, they risk shattering the fragile remaining growth. If they lower rates to jumpstart the economy, they throw a match into a gasoline-soaked inflationary fire. There is no easy escape route from this labyrinth. The central bank is currently paralyzed, opting to leave interest rates static at their most recent gathering because the war has rendered every possible move a potential disaster. They are walking a razor's edge where one wrong tilt toward higher rates could plunge an already strained, energy-starved economy into a deep, full-scale recession. The global energy market is currently weathering a supply vacuum of 10 million barrels per day as production across Kuwait, Iraq, Saudi Arabia, and the United Arab Emirates effectively evaporates. This collapse represents the single most significant supply rupture in the history of the oil trade, far exceeding any previous disruption. Analysts are now warning that if the blockade of the Strait of Hormuz continues, Brent crude is on a collision course with $130 per barrel. At that price point, the economy moves beyond mere friction and into the realm of structural disintegration, where the very foundations of corporate profitability and household solvency begin to crumble. While the International Energy Agency has authorized the release of 172 million barrels from the Strategic Petroleum Reserve, the most substantial emergency deployment in its history, this move functions merely as a temporary tourniquet. It provides a brief window of breathing room, but it cannot heal the underlying arterial tear in the global supply chain. History serves as a grim recurring script for these events, as every major energy spike over the last half-century has acted as a precursor to a broader economic downturn. The current crisis is frequently compared to the 1973 OPEC oil embargo, which paralyzed the economy for a 2-year contraction. We saw this cycle repeat in 1979 when the Iranian Revolution caused fuel costs to double, and again in 2008 when a vertical surge in oil preceded the Great Financial Crisis. Economists now view these shocks as one of the few guaranteed catalysts for stagflation. Even if a diplomatic breakthrough reopened the sea lanes tomorrow, relief would not be immediate. Markets exhibit a frustrating asymmetric behavior often compared to a fire in a high-rise. Prices take the express elevator to the roof the moment trouble starts, but they use the stairs, one slow step at a time, to come back down. This was evident after the invasion of Ukraine and the 2005 Gulf Coast hurricanes, where costs exploded in days but required a glacial recovery period of many months to normalize. As the noise of the crisis grows louder, the focus must shift from the global stage to your own personal balance sheet. You must recognize that your ultimate financial outcome is determined not by the chaos itself, but by your tactical response to it. Now is the time for a disciplined pause. Every survival instinct you possess is likely screaming at you to liquidate your portfolio and flee to the perceived safety of cash, yet data confirms this is the costliest blunder an investor can commit during a geopolitical upheaval. As one certified financial planner observed, while military conflicts may span several years, your investment horizon is measured in decades. Abandoning the market does not eliminate danger, it simply trades the temporary volatility of stocks for the permanent erosion of inflation and the devastating loss of future gains. In this environment, extreme caution is itself a high-stakes gamble, as being too conservative can result in the nightmare scenario of outliving your capital. Security in a volatile market is less about the size of your portfolio and more about the length of your psychological runway, which is currently yielding over 4% in elite high-yield accounts. If your cash buffer is currently thin, the primary objective is to reinforce it immediately. This is not a prediction of doom, but a strategic move to fortify your mental clarity. A solid liquid reserve acts as a shock absorber for your nervous system, preventing the high-cost blunders that stem from pure desperation. When you have a deep reserve, you can afford to watch the headlines with a sense of concerned detachment rather than paralyzing terror. Those who lack this financial firewall often find themselves making expensive mistakes at exactly the wrong time, effectively paying a desperation tax that could have been avoided with a more robust defense. While the first wave of gas price hikes has already made landfall, you must audit your lifestyle before the subsequent swells of grocery inflation, airfare spikes, and interest rate repricing crash over your budget. Waiting until all 5 waves have arrived to adjust your spending is a recipe for a reactive scramble. The smarter move is to aggressively trim discretionary outflows now and redirect that capital into your financial safety net. Furthermore, you must resist the primitive urge to stop your investment contributions as markets dip. It feels like throwing your hard-earned wealth into a bottomless pit, yet this is precisely when dollar-cost averaging proves its worth. By deploying a fixed amount each month, you are systematically accumulating more shares at a discount while others are fleeing. Decades of historical evidence suggest that the positions you build during the height of this conflict will likely be the bedrock of your future wealth. Those who retreat during a crisis inevitably miss the rebound, forced to buy back in at the very prices they were waiting for. You must also map out your personal energy footprint to identify where your capital is leaking. For those with extensive commutes, the financial logic of switching to a fuel-efficient vehicle has fundamentally shifted in just the last few weeks. Simultaneously, you must launch a direct assault on any revolving credit card debt. 6 months ago, the consensus was that borrowing costs would be cooling by now, but that expectation has been dismantled. The Federal Reserve is not providing an exit ramp anytime soon. Every dollar of high-interest debt you carry is now a heavier weight than it was before the war began. For small business owners, the leap in shipping costs is a warning shot to renegotiate logistics contracts or find regional suppliers before diesel surcharges begin devouring your profit margins. Success in this era is not determined by being the wealthiest person in the room, but by being the fastest to adapt. Whether looking at the 1973 oil crisis or the 2020 pandemic, the data shows a singular common thread among the survivors. Yields on premier savings vehicles have surged past the 4% mark, offering a strategic vantage point for those ready to fortify their liquid reserves. While the instinct of the crowd is to wait for a definitive catastrophe, the elite financial move is to expand your runway while the path is still clear. This isn't merely about collecting interest, it is about purchasing the mental sovereignty required to ignore the siren song of panic. When your balance sheet is armored with a 6 to 12 month cash buffer, your brain shifts from a state of survival-driven desperation to one of calculated observation. Desperation is an expensive tax on the unprepared, leading to the kind of rushed, high-cost errors that haunt a portfolio for years. By treating your emergency fund as a firewall against your own prehistoric fear responses, you transform your relationship with the news cycle from one of victimhood to one of proactive management. The families that emerge from an economic winter with their wealth intact are rarely those with the highest starting salaries, they are the ones who acted with the greatest lead time. Success in this 6 to 12 month disruption cycle belongs to those who executed boring, invisible pivots long before the 4th or 5th waves of inflation breached their defenses. Moving $200 from a monthly dining budget into a high-yield account won't make for a viral story, but it functions as a financial sandbag that keeps your household dry when the levee finally breaks. Your current sense of unease is not a sign of weakness, it is a high-fidelity data signal informing you that the window for proactive correction is narrow. The archaic software in your nervous system will beg you to freeze or pretend the storm will dissipate, but these are the exact wrong inputs for a 2026 financial landscape. True resilience is found in the quiet work, auditing your energy footprint, maintaining your automated investment contributions to capture the market's current discounts, and aggressively dismantling high-interest debt. Once these tactical movements are complete, the noise of the headlines becomes irrelevant. Media outlets profit from the amplification of terror, yet fear serves no purpose once the action plan is in motion. You have survived systemic uncertainty before and possess the capacity to navigate this volatility. The defining factor is whether you will seize the steering wheel now or wait until the disruption chooses your destination for you. If these insights have reframed your strategy for the coming quarters, share your primary tactical move in the comments. Secure your access to future intelligence by subscribing now, as the window to get ahead of this story is rapidly closing.